Now let us calculate the second part, which is the number of days it takes for the raw material to get converted into inventory. So this would be called as inventory turnovers. Okay, so inventory turnovers, and inventory turnover, the formula goes as like this. It is defined as COGS, cost of goods sold, divided by your average inventory. So if you look at the numerator of this COGS divided by average inventory, you'll note that this numerator has changed as compared to the previous formula. Please remember that this is not sales, this is COGS. Always think about the denominator when inventory is being talked about. Inventory leads to the purchases of the raw material, and this is related to your costs of your raw material. So that's why COGS comes in the numerator, and this would be the annual COGS. However, when we talk about the inventory, this is the average figure. So like the case which we had discussed regarding the receivables, this also is the average number. So say for example COGS for 2012 here, and in case of calculating average inventory, you will require both the numbers, 2011 inventory as well as 2012 inventory, and you will add these two up and divide by 2 to calculate the average inventory. So this is how your inventory turnovers can get calculated, and once you have calculated the inventory turnovers, your inventory processing days, this can be calculated as 365 divided by your inventory turnover. So let's take an example and see how this works. So let's assume that your cost of goods sold during the year of 2012 was 600, and your inventory for 2011 was 100, and for 2012 let's assume they were 300. Okay, so your average inventory comes out to be 100 plus 300 divided by 2, that is equal to 200 here. So if we want to calculate the inventory turnover, the formula would be as follows: inventory turnover, this would be COGS, that is 600, and in the denominator it is average inventory, that is equal to 200. So this comes out to be 3.0 times. And if we have to calculate the inventory processing days in terms of number of days, this would be 365 divided by 3.0. So this will come out to be approximately 122 days. So what do we interpret by this 122 days? We can say that the time taken for the raw material to be processed into work in progress, and from work in progress to finished goods, and to the time where the sales process is just complete, this whole time is basically 122 days for the company. So the last one, which is basically related to the purchase of the raw material, and we will call this as purchase turnovers. Purchase turnovers can be calculated as purchase during the year. So let's say 2012 you've purchased certain amount divided by your average trade payables. So trade payables are the ones which are yet to be paid to your suppliers, so that number will come here. So since this word average is used, if we take this example of 2012 purchases, you will need to use 2011 and 2012 both trade payables, add this up and divide by 2 to find out the average here. So once you have found the purchase turnovers, you can calculate how many number of days you take for the days payable. So days payable will be calculated as 365 divided by your purchase turnover. So let's take another example and see how this works. So say for example during the year you made the purchase of let's say 500, and your trade payable in 2011 was say for example 100, and let's say trade payable In 2012 they were 300. So in order to calculate the average trades payable, this would be 100 plus 300 divided by 2, so we'll have this as 200. Your purchase is 500, so essentially if you want to calculate the turnover, this will be 500 divided by 200. This is equal to 2.5 times, and you can calculate the number of days payable. This will be 365 divided by 2.5, so this comes out to be again 146 days. So essentially we are saying that in our cycle where we had seen the purchase of raw material from inventory to the finished goods to the selling process, the total cash conversion cycle is basically calculated as your receivables days plus your inventory days minus your payable days. So this would be receivable days we have calculated earlier, this was 146. Your inventory days, let us see how that was, that is 122 days, and your payable days again was 146 days. So your cash conversion cycle is essentially 122 days in this case.